Good afternoon. Thank you very much for joining us this lunchtime for a live masterclass. This is a series of webinars we're doing on different financial planning topics. Today's is on UK pension planning for expats. So if you have a UK pension that you had whilst you were working in the UK and you're no longer living there, then this is the webinar for you. It's quite a complex area, and we'll just scratch the surface today. I could probably go on for hours and hours on the subject, but we'll try and keep it brief and to the point. So let's get going. Just out of on a side, most there's only one in 10 people from the UK now lives abroad. That is about 5 million people. So there's a lot of people with pensions and they're really not sure what to do. So this is really for them. To understand and a starting point to go forward. If you look at the reasons why people leave the UK, it's generally for work. These are statistics from the National Office for Statistics, but you can see that most people are leaving to work overseas. And where do they go? The big one is Australia, and then there's the European countries, but mainly the old Commonwealth states is where people end up going to. If you've got a pension scheme and you're just not sure where it is or what type it is, then there is a pension tracing service. And the people in Newcastle will be able to help you find your old pension schemes. We as a company will do that as well. We can find those schemes. Really, you need your national insurance number. That's the key to it. And with that, you can generally find out where an old scheme is. Obviously, you need to know where you used to work and, if anything, what type of what company it was with. But there's a starting point. Once you've done that, you've got to work out what type of pension do you have. There's a couple of different variations of them. Generally, a pension scheme pays you an income on retirement. But how you get to it in the accumulation stage and how you get at it in the de-accumulation stage is important. So the first one is a defined benefit or a final salary scheme. Very popular a couple of decades ago. They're now not so popular today for various different reasons. The second one is a defined contribution or a personal pension scheme. The third is effectively a government scheme, like a state pension, and then there's some other schemes as well, just to complete the circle almost. We're going to concentrate on the first three today because that's the most popular, and that's really what people have and what they can do with it. So the first two are DB and DC, defined benefit and defined contribution. These are all-encompassing terms for them. But if you look at a defined benefit, then that really provides an income on retirement based on your final salary. And then within the scheme is normally an employee scheme. There'll be a calculation or a factor to take into account to see how much you get of your final salary. It's really based on the number of years that you work for that company. And then you put it into the calculation. And there's calculations, you may have heard of 60ths and 80ths. So if you work for your company for 30 years and it was a 60th scheme, then it's 30 divided by 60 and then times your final salary. So if your final salary was 100K, then you're going to get 30 divided by 60 is 2, and it's so £50,000. It will be your final salary. Will be your pension and retirement. They tend to be guaranteed, so you know you're going to get that every single year, along with some increases in there. Depending on whether the scheme is still in existence or if it's still around. So that's been the big debate recently, is whether the old final salary schemes can sustain those payouts. But there's a whole area on that one. The other option is a defined contribution, and really this is just you're putting money into a fund. Your employer might put some money into a fund. The government will put some money into a fund in the form of tax relief, you grow that, you get investment return on top of it, and then at the end of the time when you come to take your benefits, when you come to retire, it's the value of that fund that will determine how much you get. And at that point, you can either buy an annuity, or you can take some money out of it as a drawdown. We'll come on to that. You can take some element of it as tax-free without paying tax on it. And again, we'll come on to those later on down the line, but it's really a case of how much cash was put into it, not based on any type of calculation of your end salary. There's also the UK government, and from April this year, there's a one single pension, and this would be about £155 per week. There was obviously criteria for this to get that amount, but it will rise under the triple lock, which is CPI, either 2.5% or earnings. So one of those calculations will be applied to every year. So it's likely to grow in the future. But how do you get it? Well, now you need a minimum of 35 years in national insurance contributions. Before it was 30. If you have less than 10, then you won't receive a pension scheme. And if you're living in the EEA state or the US, then you'll receive the increases in payment. The EEA is the European Economic Area, so Europe basically, and a few other countries around it. If you're living in, say, Australia, New Zealand, Canada, Singapore, other countries, then you're not going to get those increases in payment. And there was a court case a few years ago where a couple of expats tried to take the government to task over it, but they actually lost it. So bear in mind when you come to take your basic state pension, what the rules are around surrounding it. If you want to make contributions to receive the basic state pension, then you can do as an expat. You can make voluntary contributions. Couple of criteria, as always. You need to have lived in the UK for a continuous 3-year period, and you need to have been paying national contributions before you come abroad for at least 3 years. Some of the benefits of doing this, if you live in the EEA area, then you get to have certain benefits such as reciprocal health insurance or health cover. Obviously, when you return to the UK, you'll have the health insurance and some state benefits like bereavement payments. But obviously, the main one is the full state pension. So it's certainly worth making those contributions or having a look at what your status is with them. We did a webinar a few months ago, and we'll probably do one in the coming months to update on the changes. You can make contributions to a UK pension scheme. You have to have really have UK income tax in order to make those contributions, because that's what it's offset against. But if you're working for the Crown over employment, or you were in the UK in a pension scheme, then you can make contributions for 5 years. You can also make ad hoc contributions. You just won't receive the tax relief on top of it. So you can put up to about 40k into it to receive tax relief. But it is certainly possible to make contributions. It will depend on the scheme, though. Some schemes will say we won't accept it. So it's really down to the pension company whether or not they would do it. But really, it's 100% of relevant taxable earnings, or you can do 3,600 as well, up until 40k. What about taking the benefits? As mentioned before, you can take a lump sum, 25% tax-free cash. This is in a defined contribution scheme, but if it's in a defined benefit, then it's really down to the set scheme rules or set amount from that. They generally tend to be similar, but the odd scheme may have slightly different rules. So it's just worth understanding what your scheme benefits have. After that, you tend to take an income. These schemes is from age 55, but the scheme rules tend to be have a set time, so that could be age 65 or 62, and could be even a bit higher than that. So again, check your own scheme. If it's under a defined contribution, though, you can take an income from the scheme. This is set by the amount that you want to take. New rules came into it a couple of years ago, which you set the amount that you want to take from it. So you can take large lump sums, or you can take an income. Again, it does depend on whether the scheme will allow that to happen. Not all schemes will do this, what's it called, flexible drawdown. So again, check with them. Or you can buy an annuity. Those options still exist. In certain circumstances, it may be the right thing to look at. They've taken a bit of a battering over the years, but it doesn't necessarily mean that's not going to happen. Under a scheme rules for a DB, the company may buy an annuity for you, or they may just do the drawdown from the assets. Again, it depends on the individual scheme and what the rules are with it. So again, worth checking out. But when you take income, you will pay tax, and this is quite important. So these are the tax rates. So the first 11,500, the tax rate is 0. Up to 32,500 is 20%, and then 40 and 45. So if you are taking an income every year, then you're going to be paying tax depending on which band you go into. But if we mentioned earlier about flexible drawdown, so if you took a large lump sum, say 100,000 out of your pension scheme as lump sum, you'll pay tax at your marginal rate. So you can see from that table that 100,000, you're likely to be into the 40% tax bracket, the marginal rate at that point. So you'll be receiving the money less the tax. As an expat, there are some things to think about. Each country will have a double taxation agreement with the UK, and it really depends on what kind of which country you're in and what the DTA is. They are all different, but you can claim the tax to be paid gross or without tax in the UK, but it'll have to be paid in your home country, or the country you're resident in. So worth exploring it to see what kind of taxation agreements exist, and how that can be beneficial for you. So the HMRC have all of the claim forms on there, but they also have all of the DTAs on there. Very dry subjects. It's worth getting some advice, depending on where you're a resident at the time. Once you've done that, it's a case of, well, what are my options? First option, do nothing. Leave it where it is. If you don't want to, if you want to keep the scheme and you want to take the benefit from it, then by all means you can. Look at the tax, look at where you're living, but it's certainly an option. You can move it to a defined contribution scheme, or a personal pension scheme, such as a SIP, which is a self-invested personal pension. It's just a variation of a DC scheme. Lots of acronyms in this presentation. There are advantages and disadvantages to doing that, or you can move it to overseas, to something called a qualified and recognised overseas pension scheme, or a QROPS. Very topical at the moment, but basically a pension scheme in your home country, or maybe even in a third-party country. There are some benefits to it, but we can come on to those. A QROPS, as mentioned, is just a scheme in another country. This could be somewhere like Australia, the US, New Zealand, some of the European countries, and you won't be taxed in the UK. You'll be taxed under local rules. SIP is an option for an expat. It just means that you get control of your pension scheme. You can maybe change the investments underneath or follow your own strategy, and you have the option to decide when to take those benefits. So if you've got an existing pension scheme and you want to take advantage of either of those options, then it's just worth looking at. See what your current structure is, and then whether or not there's any advantages in trying to move it to these two options. I'll touch on the QROPS advantages and disadvantages. The big disadvantage at the moment is that there is a tax charge if you move it to another jurisdiction that you're not resident of. unless you're in the EEA. So for instance, if you're living in Australia and you have a local Australian superannuation scheme, you transfer your pension to it, then you won't get charged. If you're living in Singapore and you want to move it to your Australian pension scheme, then there'll be a tax charge of 25%. If you're living in, say, Spain, and you move to a jurisdiction such as Malta or Gibraltar, then you won't have a tax charge on it. But if you're living in Thailand, for instance, and you moved your pension scheme to Gibraltar or Malta, then there will be a tax charge of 25%. The advantages are that you have control. It's out of the UK. You're down to the local rules or the local taxes, but you're not subject to UK tax. So this could be the income tax, but also something called the lifetime allowance. So if your pension scheme is over £1 million, then there could be a tax charge on top of that. So you're trying to avoid that net and not have that issue in the future. There's also the different currencies. That tends to be a big factor for people who are living in one country. You've got a local currency, could be dollars or US dollars, and then your pension scheme is denominated in sterling. So you obviously have a currency fluctuation at that point. So it's trying to minimize those issues. There are some factors to consider, and this is really important. It is individual, and it really should be your own circumstances that dictate it. But some of the factors are like, where will you live? If you're living on the quintessential tropical beach, then do you want your pension scheme to be there, or are you happy to have it in the UK and pay to you? We touched on the currency issues. So there's lots of factors to consider when you're picking a new residency, or you're now resident in one country. It depends on how much access you want. Would you like to have the option to take those lump sums, or to take a less income in 1 year and take a higher income in another? Certain schemes will restrict you on those, such as a defined benefit, but also some of the old defined contribution or personal pension schemes will restrict you as well. So it's a case of, do you need the access to pension, and how much do you want in retirement as well? Some countries will have a lower cost of living, or they might not tax certain pension benefits. So it's a case of, where do I get my income from? How much do I need to live day to day? The other big factor is, what's your risk level? When we were talking about defined benefit schemes earlier, you said there's a guaranteed amount that will always get paid to you, assuming the scheme is still around. If you moved it to a defined contribution or a personal pension, then those guarantees will disappear. It's really down to your investment performance, on the investment performance on the underlying assets. So you could therefore receive less than what you would have had if you're in your original scheme. So it's understanding that there are risks in doing this, and you may not receive what you're expecting. So if you're inclined to not take those risks, then sometimes not doing anything is the right option. But really, you have to look at the current schemes to see what the structure is. So if you've got a defined benefit or you've got a personal pension, what are the rules around that? Can you get access to it? What amount can you take? Do you have to buy an annuity? Starting with that is very important. Some of the death benefits on the scheme will ensure that maybe on a defined benefit, your spouse will only get 50% of the contribution or of the payments in the future. Your children and your grandchildren may not get anything from it. So if you wanted to, say, provide for the family in a family trust, or move it on to the next generation, then you have to consider what are the factors in doing that. But the biggest fear is running out of money in retirement, the longevity of it. Under a defined benefit, they'll keep paying you until you die, whereas when you've taken the fund under your own control, it will pay as long as there's an amount in there. So if you run out of money, then you need to look at alternative sources of income. multiple streams of income for expats is the key for retirement. Have different pots in different places, and a pension scheme is just one source of those. So in summary, 3 options. First one is do nothing, leave it where it is. Take your benefits, let it accrue where it is, let it grow. When you come to retirement, you just take the income as and when you would be if you were in the UK. Second option is you move it to a scheme that maybe you have a bit more control over in terms of the investment and being able to designate who receives it. On a third option is to move it overseas. But there could be tax advantages in there, but there could be a tax disadvantage at the moment. But one thing is clear, that it's a very complicated subject, and the implications are huge if you get it wrong. So you should take advice, and you should seek someone who has qualified in the UK or has UK qualifications. Ask to see them. This could be a diploma from the Chartered Insurance Institute, the CII. They run the exams to give the basis for advisors to give advice. But it's very important to ensure that you get someone who has those kind of qualifications, because they'll understand the different structures and the implications if you were to move it or start to take your benefits, and how you take the benefits. It's a very, very complicated subject, so taking advice is extremely important. So thank you very much. If you have any questions, here are my details on here. So email, telephone, you can go to my website if you want to get in contact, or there's a Twitter account if you want to go that route. By all means, take advice on your pension schemes and see how they fit into your overall financial planning. As an expat, you're a little bit different from maybe if you were in your home country, so it is important to take advice. So thank you very much.